Hello everybody, so this is the third video associated with chapter 1. So at the end of the last video, we mentioned that derivatives, or for an example options or futures or forward contracts, can be used for three main purposes: risk management, speculation, and arbitrage. So in what follows, we're gonna provide some examples for the first two cases, well, especially for the first one for the risk management case, but also some examples associated with speculation. So the first, so the idea we're gonna use often in upcoming slides is the combination of positions on various options. So instead of considering a single option at the time, we'll consider a portfolio of options and look at the payoff of the portfolio. Okay, so in what follows, we're going to consider only European options, and we're going to assume that they have the same underlying asset and the same maturity. So the first strategy that we're going to consider is called a call-bull spread. It entails doing two things: purchasing a call option with a strike K1 and selling a call option with strike K2, where K2 is greater than K1. Okay, so you can add the payoff of these two options, and if you plot the payoff function as a function of the underlying asset value at maturity, you get something as follows. So we're gonna skip a few slides, and then on slide 74 you have the payoff function of the call-bull spread here as a function of the underlying asset at maturity. So we see that if the underlying asset value is smaller than K1, you have zero payoff. If it's greater than K2, you have a fixed payoff, which is K2 minus K1. And if the underlying asset is between K1 and K2, then your payoff is an increasing function. So this strategy can be used for speculation because it provides a payoff if the stock or the underlying asset price goes up, and it doesn't provide a payoff otherwise. So this can allow speculating on a future increase in the market price of the underlying asset. So this is a call-bull spread. Now we're gonna go back and talk about the second strategy, which is a put-bear spread, which entails purchasing a put option with strike K2 and selling a put option with strike K1. Okay, so if you do that, and if you look at the plot of the payoff from this option strategy, so first I say look at the payoff of the plot, but to do that, you simply have to add the payoff of a put option here minus the payoff of the second put option. And if you do that and plot it, you obtain what follows here. Okay, so here I just give the result, but I invite you to do that at home by yourself to replicate this plot manually to understand how you can obtain this. So the payoff plot of a put bear spread is as follows. So we see that you have a positive payoff of K2 minus K1 if the underlying asset at maturity is worth less than this K1 value. Conversely, you have a zero payoff if the underlying asset value is greater than K2 at maturity, and if the payoff, the underlying asset value is in between K1 and K2, again, you have some increasing function here. So this allows speculating on a downward movement of the underlying asset. Okay, so if you really believe that, for example, some stock will go down in a short future, you might set up a put bear spread and hope to collect the premium associated with downward movements for that strategy. So this is a second strategy. Now, third strategy is the butterfly spread. So how do we set up the strategy? Well, first consider three constants K1 smaller than K2 smaller than K3, and we're gonna assume that K3 minus K2 is equal to K2 minus K1, meaning that the distance between K1 and K2 and K2 and K3 is the same. So in that case, what you can do, you can purchase a call option with strike K1, sell two call options with strike K2, and buy a third call option with strike K3. So if you do that, you can show, again, I invite you to try doing this calculation at home, but you can show that the plot of the payoff has this form here. So this is the payoff function of the butterfly spread, and we can see that it has a positive payoff if the stock price remains in between K1 and K3, but it has a zero payoff otherwise. So this spread, we use the word spread, but it's in fact a combination of options. This combination allows speculating typically on low volatility in the markets. Okay, so if you presume that stock prices won't move a lot in the market in the next few days, well, let's say the current price is K2, you can set up a butterfly spread around K2, and if the stock price remains within this region, then you're gonna earn a positive payoff. But if the movement of the underlying asset is very large, so either very negative or very positive, then you'll get zero payoff. So and in that case, because you paid the premium to set up this strategy, you're gonna lose money. So this allows speculating on a low volatility in the market. Then we're gonna see a fourth strategy, which is the ratio spread. So the ratio spread can be achieved by purchasing a call option of strike K1 and selling M call options of strike K2, with K1 being smaller than K2. Okay, so if you so I don't think I've provided, no, so I didn't plot the payoff function, but let me take the pencil here. The payoff function, it looks like something like this. Okay, so has a zero payoff, then suddenly at K1 it goes up with a slope of 1, and then at K2, so this is K1, and then at K2 here, okay, so on this part the slope is 1. Sorry, it's not very well drawn, but at this part here it starts going down, so it might go like this, but the slope here will be m minus 1. Okay, so slope, or sorry, 1 minus n, in fact, equals 1 minus m. The 1 comes from the slope associated with the first option, and the m comes from the fact that you've sold m options. So in that case, again, this option is another way that allows you to speculate on low volatility in the market, because let's say price don't move a lot and remain stuck in this region, then you get a positive payoff. But if the price moves a lot and becomes very large, then you become in this region, and what happens is you get a negative payoff. So you have to pay money in that case, which can be very costly. So this is another strategy which allows speculating on low market volatility, but in that case, you have a further downside, which is that if the stock price becomes too large, then you can lose a lot of money on this. But because you have this additional downward risk, this strategy is typically less expensive than a butterfly spread, because of that. More risk means cheaper, cheaper. That's it. Okay, so I'll just erase this thing. Uh, Let me remember how you do that. Undo. Okay, here you go. Okay, so this was another strategy, and then we're gonna see a final strategy for speculation, which is called a strangle. A strangle entails purchasing a put option with strike K1 and purchasing a call option with strike K2, with K1 being smaller than K2. And this, contrarily to the butterfly spread, this allows speculating on um, high volatility in the market. So if we look at the payoff here, this is the payoff of a strangle. So you see that you get zero payoff from this strategy if your stock price falls between K1 and K2, but you have a positive strategy if there are large movements of the stock by the maturity, and if it ends up either in this region or in this region. Okay, so if you're pretty sure the market volatility is higher than what is currently reflected by market prices of options, then you might want to buy this strategy and profit from it. Okay, so just a quick note, when K1 is equal to K2, the strangle is called a straddle. Okay, so for a straddle, if you look at the plot here, the distance between K1 and K2 would be 0, so you would just get one bar like this and another bar like here, so no kind of plateau in between. Okay, so these were various option strategies. I've shown the application related to speculation, but of course these can be used for risk management purposes. So, for example, let's say you're vulnerable. Uh, your company, you know, it's gonna lose a lot of money if the value of some asset goes up. Then you can buy a callable spread to compensate such loss and offset losses on other positions your company has. Okay, so here I've given the speculation use, but of course these can be used also for uh, risk management or even for arbitrage in some cases. Okay, now I'm gonna provide simple strategies relying options which are used for risk management purposes. So a first strategy is called a protective put. So the protective put entails combining the purchase of the underlying asset and of a put option. So in that case, the put option acts like insurance. Okay, it's for protective purposes. Why is that the case? It's because uh, if ever the price of the underlying asset falls below some value K, then you can exercise the put option and receive K dollar and give the underlying asset to the counterparty. So your net position will never reach below K dollars. So this is why we call that protective put, because it floors the amount of payoff you can get from that strategy. Okay. The downside of this is if you buy a put to protect yourself, you have to pay the premium. So of course, paying that premium will reduce your average profitability. Um, okay, so collar. This is another strategy which is used for risk management purposes. So what's a collar? A collar entails combining the purchase of a put option with strike K1 and the sale of a call option with strike K2 such that K1 is greater than K2. So if you look at the payoff simply of the strategy, you will get something like this. So you purchase a put, so it looks like something like this, and something like this. So this is K1 and this is K2. So this is a collar. Okay, so in itself, you could look at it and say this entails speculating on the market price of the asset going down. But often the collar is combined with the purchase of the underlying asset. Okay, so if you purchase the underlying asset, the payoff of the underlying asset is ST, and if you combine this payoff to the payoff of the collar, you would get, I invite you to do this at home, but the combined payoff would be of the form here, here, here. Okay, with respect to this is ST. So this is the payoff. Okay, and the payoff, this would be K1 and K2 here. So this is the payoff, not of the collar, but the payoff of the collar plus the underlying asset. So you can see that this caps and floors the total payoff of your portfolio. So you remove upside risk by selling the call option. So if your underlying asset price, so okay, this is K2 here and K1 here. So if your underlying asset price goes above K2, then by selling the call option, you remove any upside risk above K2. So if your asset has a terminal value at T of more than K2, then combining the underlying asset and the option will lead to a payoff of K2. But conversely, if the underlying asset here is worth less than K1, then your total payoff becomes of the combined collar and underlying asset becomes K1. So in that case, you floor your total payoff. So this strategy allows removing upside risk in order to get some premium, and typically you use that premium to purchase the option with K1 and remove downside risk. Okay, so if you're averse to risk, you might be willing to lose a bit of upside risk in order to protect yourself from downside risk. Okay, so this is a typical strategy involving options that is used in practice for people who are ready to remove or to forfeit some upside risk in order to protect themselves with downside risk. So for the collar, there's something called a zero cost collar. The zero cost collar is when the premium of the put option with K1 is exactly the same than the put option, the premium for the call option with strike K2. So if the premium is the same, then entering the collar position has zero net premium, so you can enter it for free. Okay, so if you purchase the underlying asset for the same price, you can purchase the underlying plus the collar because the collar is free and you can get instead that form of payoff. Okay. Okay, so for all aforementioned strategies, except the ratio spread, the payoffs were always positive, or at least always non-negative. Does it mean it's an arbitrage strategy? Does it mean it's something where you will automatically get an amount of money for free? The answer is no. The reason is that if you set up a callable spread, although your payoff will be non-negative, you will have to pay a premium to enter in this strategy. So you have something to pay. So the initial price of the portfolio is not zero in that case. Okay, so these aren't arbitrage strategies. Okay, so this means that even if your payoff from this strategy is greater or equal to zero, your profit from it will not be greater or equal to zero in all cases. Because to to calculate the profit, you must take into account not only the payoff, but the premium you paid to enter this position, which is a cost. Okay, so we're gonna define the profit in the context of an option strategy as follows. So the profit of an option transaction is defined for the purposes of this course as the future value at the option maturity date of all cash flows associated with the transaction. And when we talk about future values, we must take into account interest rate. So what interest rate will we use? We will use the risk-free rate to compute these strategies. So what's the risk-free rate? We'll talk a bit more. We've in fact talked a bit about this in the bonds introduction. But risk-free rate is an interest rate at which you lend to somebody who will repay you with probability 100%. Okay, so if you borrow money to a borrower which is riskier, you will charge higher interest rate, but the lowest possible interest rate you would charge to somebody with zero risk of not repaying you is called their risk-free rate. Okay, so then we will illustrate notions of payoffs versus profits by looking at the simple option transaction. So here, let's consider that case. Bob purchases a European call option. Its strike is $105. The maturity of the option is 3 years. The underlying asset is worth $100 today. The option premium is $5. There are no dividends. And finally, the continuously compounded risk-free interest rate is 2% per annum. Okay, and again, we're going to assume, it's not written here, but an implicit assumption is that the underlying asset would be storable. Well, in fact, no, you don't even need this assumption here. Sorry about what I just said. Forget about that. Okay, so here the question is, what is the profit generated by this option purchase if, let's consider two cases. The first is if the underlying asset price becomes $120 in 3 years. And second case is what is the profit if the underlying asset price becomes $100 in 3 years. Okay, so what happens if ST is equal to 120 or if ST is equal to 100? Okay, so answer, we said that the profit of an option transaction is the future value of all cash flows at the option maturity date accrued at the risk-free rate. So this means the profit is equal to the future value of the payoff, which is the payoff itself, because the payoff in the case of a European option is provided at maturity, minus the future value of the option premium, which is what you pay to get into an option transaction. Okay, so here the payoff for a call option, it's maximum between 0 and ST minus K. We've studied that earlier in this chapter. And here the premium, we said it's C0, but because we consider its future value, the future value is C0 times this guy, which is the interest accrual factor, which is the exponential of the risk-free rate times t. So here we'll calculate the profit in two cases. So the first case is what happens if S capital T becomes 120. Okay, if the underlying asset value at maturity becomes that value, then we can just plug in the numbers in the formulas, and then profits would be maximum between ST minus K minus the future value of the premium. So here in that case, ST would be 120, K is the strike 105, minus here the future value of the premium, which is, this is the premium, $5, and this is exponential of the risk-free rate here times 3 here is the maturity. So in that case, the profit becomes $9.69. Conversely, if the underlying asset price becomes $100 in 3 years, then profits would be given by the same formula, but now instead of having 120 here, you have $100. So the maximum, this is the maximum between 0 and minus 5, so this becomes 0 minus the future of the value of the premium, which is minus $5.31. So in the second case, even though its payoff was non-negative, in fact the payoff was 0 in this situation, Bob incurs a loss, okay, because he gets 0 payoff from the option, but he had to pay a positive premium to enter this strategy or this transaction. So at the end, he will have lost money from that deal. Okay, so this can be seen not from the payoff, but from the profit. Okay, so in practice, options are traded on the market. So a legitimate question is, what should be the price of the option? What is sound value for the premium in an option transaction? Okay, so again, to try to answer this question, we're going to make the following assumption. We're going to assume that there are no arbitrage opportunities in the market. Such assumption we saw allowed us to determine forward contract prices and futures prices in a unique manner. Okay, so if you assume the absence of arbitrage, then there's only one single possible forward or futures price under the few assumptions we assumed earlier. Then we might wonder, is it possible to obtain the same results for options? So by saying there's no arbitrage, do we get a single possible value of the premium? And the answer is no. There are multiple, just assuming the absence of arbitrage is not sufficient to determine uniquely the value of the premium, but we're going to see that we can still achieve some results, which is we can get bounds on the premium of options from assuming the absence of arbitrage. Okay, so in subsequent chapters, we're going to see option pricing methods to try to determine a single price for an option, but here in this chapter, we'll instead simply look at bounds implied by the no arbitrage assumption. So bounds on option prices or option premiums. Okay, an assumption we're going to make here is that it's always possible to borrow money or lend money at the risk-free rate. Okay, so we're going to assume the existence of what we call a risk-free asset, which is equivalent to having the ability at all times to borrow or invest at the continuously compounded risk-free rate RT. Okay, so if we invest in that asset, then the time t value of this asset is given by this. The time t value is the exponential of the integral between 0 and t of the short rate at time s, where s goes from 0 to t. Okay, so this is the regular interest rate accrual formula for continuously compounded rates. So here B, you can think of this asset either as some bank account or like credit margins if you have a negative amount of this asset. So it's having a negative amount of asset is equivalent to saying you're borrowing, and borrowing is some form of credit margin. Okay, furthermore, we're going to assume that the risk-free rate is always greater than 0 at all times, so it implies that BT will be an increasing function of t. So if t is greater than s, then BT will be greater than BS. Okay, so the absence of arbitrage we've postulated, we're going to see it leads to multiple general results associated with the pricing of financial derivatives. So the first, some of them are these results are very obvious, some of them a bit less. Okay, So the first result is the following. Consider an asset whose time t price is AT and whose payoff at maturity is psi t. Then A capital T is equal to psi capital T, which means that at the maturity of an option or of a derivative, its price must be equal to its payoff. So we can prove that, and the proof is pretty straightforward in that case. So if at maturity the price of a derivative is smaller than the payoff, then there's arbitrage by simply purchasing the derivative at AT, and because it expires exactly right now, then as soon as you purchase the derivative, you receive the payoff psi t, and so your net cash flow from that would be the payoff minus what you paid to obtain that payoff, which would be greater than zero. So this would clearly be an arbitrage opportunity. Conversely, if A capital T is greater than psi t, so if your price at maturity is greater than your payoff, then you can sell short the derivative at time t. And by doing that, then you would receive its price, but because you're selling it short, the option is going to expire and you'll have to return the payoff to the person to whom you've borrowed the option. So you'll have to return the payoff psi t. So your net cash flow from that transaction would be you receive the option price and you pay its payoff, which is greater than zero. So this again would be arbitrage. Okay, so the only possible value for the price at the maturity of a derivative is its payoff. Okay, second theorem is monotonicity theorem. So again, this result is pretty obvious. It means that it says that if some derivative pays you more money than some other, then the one which pays more money should be more expensive. Okay, so this is very logical. So we can state this result more formally like this. So let's consider two derivatives. I've put a footnote here, so these can be portfolios of derivatives instead of single derivatives of the European type. So we're going to assume that the payoff is given at a single possible date capital T. And we're going to assume that the two derivatives have exactly the same maturity capital T. So exactly the same maturity. And we're going to denote their respective prices by UT and AT. So these are the prices times small t prices of both derivatives. And their associated payoffs are respectively phi u capital T and phi a capital T. Okay, so these are the price of the derivatives. These are their payoff. So the monotonicity result says that if the payoff of derivative u is greater or equal to the payoff of derivative a with probability 1, so if you're certain to have at least more money from derivative holding derivative u than a, then its price, the price of derivative u must be greater or equal to the price of derivative a at all times t. Okay, so this is obvious, but again, it's useful to state it because we're going to use that result in subsequent theorems. So again, how do you prove this? Well, what we do is we're going to assume the converse and then get to contradiction. Okay, so if the derivative u, which gives a higher payoff, has a smaller price than derivative a, then what you can do is buy the cheap one and sell the expensive one. So if you buy the asset u and you sell, or maybe sell short the asset a at time t, then you can invest the sales proceeds, which is the difference between the prices of the two derivatives, at the risk-free rate in the risk-free asset. And then in that case, the profit of these transactions, where the net initial cost is null, is the following. So the profit from that is um, the difference between the two options, because you've purchased U and you've sold A, so you get the price of A minus the price of U. This is the interest rate accrual factor between time small t and capital T. So this, by our assumption here, this should be strictly greater than zero. And furthermore, so this is the premium, future value of the premium, and the payoffs here, because you've purchased derivative U and you've sold derivative A, you will get the payoff of U minus the payoff of A because you've sold this one. But we said by our assumption, psi U is greater or equal to psi A. So this is strictly greater than zero, which means that this is an arbitrage opportunity. Okay, so this completes the proof. And just a quick note here, we said that the initial net cost is null. It's because when you make these initial transactions here, the money you receive from these transactions, you uh, um, immediately invest them in the risk-free asset. So your net cash flow at time small t is zero because what you receive, you invest it right away. So you have no immediate cash flow at time t from that strategy, small t. All the cash flows are at time capital T. Okay, so this was for European options. Again, we can state a similar result for American options. Okay, so if we have again two derivatives or two portfolio of derivatives of the American type, meaning that both can be exercised at any time until the maturity capital T. And if they have the same maturity, so same maturity capital T for both options, then if we, let's use the same notation, so we're going to assume that the respective prices at time small t of the two derivatives are ut and at, and their payoffs are respectively psi u tau or psi a tau. So here, what's tau again? Tau here will be the time at which the option is exercised. So both options, they don't necessarily need to be exercised at the same time, but so you could have a different tau for the two options. And the result, the monotonicity result is as follows. So if the payoff of option U is greater or equal to the payoff of option A at all time S, all possible time S, with probability 1, then the price of the option with the highest payoff has a price that is greater or equal to the price of the second option. Okay, so what's the proof for that? So suppose it's not the case. Suppose the option with a higher payoff has a cheapest price. Then you can get an arbitrage strategy by doing what follows. So you would buy the cheap derivative U and sell the expensive derivative A. So in that case, you would take the proceeds of the sale and invest it in the risk-free asset until time capital T. And then what happens is you've sold the option A, but you hold option U. Okay, so here this is a typo, so this should be an A and this should be a U here. So if option A is exercised by the option buyer at time tau, so if your counterparty to which you've sold option A exercises, then right away you exercise your own option U. Okay, so at the exact time the option you sold is exercised, you do exercise your own option. And in that case, you will invest the difference of payoffs in the risk-free asset at the time of the exercise. So what's the profit from that transaction? The profit is the difference of prices of the two options because you've purchased you've purchased U, so you paid its premium, but you sold A, so you received its premium, times the interest rate accrual factor between small t and capital T. Plus, here this is an indicator which says 1 if the option is exercised before maturity or 0 otherwise, times the difference of payoffs from both options, because we said that as soon as option A is exercised at time tau, then you do exercise option U and you receive its payoff at the same time, times the interest rate accrual factor between tau, the time of the exercise, and the maturity date of the option. And we see that this term, if the option is never exercised, this term just becomes 0 because of the presence of this indicator. And because this guy was strictly positive, then the profit is strictly positive. Again, this is also greater or equal to 0 because this was our assumption from the result. So this is a strategy with 0 initial cost and a payoff which is greater or equal to 0. So this is not only a payoff, a profit which is strictly greater than 0. So this is an arbitrage opportunity. Then there's a third result which is kind of obvious, but that we can prove formally. So if we have two derivatives, so before that, this result is called the law of one price. It says that if we have two derivatives or portfolio of derivatives of the same time, so same type, so let's say two American options or two European options, which have the same maturity date and the same payoff, then their prices must be equal. Okay, one another. So again, we've assumed that these are options on the same underlying asset again. Okay, so basically this says that if you have two options which have exactly the same payoff, then they must have the same price, and this is pretty obvious. Okay. Again, so the proof haven't put it here, but the proof there are few ways you can prove that. First one is if the price discrepancy is if two options, for example, have the same payoff but a different price, then you can set up an arbitrage strategy by buying the cheap one, selling the expensive one, and then both options payoff would cancel out at the future date, and you would reap as profit the future value of the price differentials associated with the two options. The other way to prove that is very simple. It's from combining previous results. So let's say here, so maybe let's write a bit. So this result says that if psi u is greater or equal to psi a, then it means that u must be greater or equal to a. But you get from the same result, you can call a u and call u a, and you would get the following. So if psi t u, sorry, I go quickly with the notation, is smaller or equal to psi a. So if the payoff of derivative u is smaller or equal to derivative a, then u must be smaller or equal to a. So the price of u must be smaller or equal to a. So if you do that in both directions, so if psi u is equal to psi a, you have both this condition and this conditions met. So this condition and this condition must hold at the same time. So if u is greater or equal and smaller or equal to a, it must be equal to a. Okay, so this is another way you can prove the law of one price. Okay, so these were very general option pricing results, but then these can be used to get more precise results associated with option pricing. Okay, so here in upcoming slides, we're going to derive some bounds associated with option prices. and we're going to use the following notation. Okay, so capital T denotes the maturity of the option, capital K denotes the strike price of the option, and we're going to assume that all options have exactly the same underlying asset. So here, capital C, T, capital T, capital T, will be the time T price of an American call option at maturing at capital T, and whose strike is capital K. Okay, so capital C denotes the price of an American call option. Lowercase c denotes the price of a European call option. Capital P will be the price of an American put option. Lowercase p will be the price of a European put option. And here Z small t capital T is, as previously assumed, the time t price of a zero coupon bond maturing at time capital T. So by maturing, we say pays exactly $1 at that time. Okay, so this is the notation we're going to use in upcoming slides to discuss bounds associated with options. Okay, so again, we'll make the same assumption we did earlier in this chapter because this is needed to derive the upcoming bounds we're going to show. We're going to assume that the underlying asset is storable for an indefinite amount of time without any cost. Okay, so you can buy the underlying asset and you can store it for how long as you want without having any fees, storing fees to pay. Okay, so this assumption is needed to derive upcoming results. Okay, so the first proposition is the following. So if we have two possible values of the strike, capital 1 smaller or equal to capital K2, then the price of a call option with strike K1 is greater or equal to the price of the option with strike K2. And this is true for both a call option and so for both the American call option and the European call option. For put options, it's the opposite result. So the price of a put option, American put option with strike K1 is smaller or equal to the price of the American put option with strike K2. But, and also we have the same result for European put options. Okay, so how do we get these results? Well, this is directly obtained from the monotonicity theorem that we've seen earlier. Okay, so if you exercise the option at a time capital T, then you have that the exercise value, if your strike is K1, is greater or equal to your exercise value at time T if your strike is greater K2. Okay, so because the exercise value when the strike K1 is greater or equal to the exercise value when the strike is K2, then the price associated with the former option must be greater or equal to the price associated with the second. Okay, so this is pretty obvious. Same thing here. So for European options, if we check out the payoffs on their terminal date, the payoff of the former option is greater or equal to the payoff of the second option in all possible scenarios. So we must have this relationship. Now for put options, the equalities or inequalities are reversed. It's because the payoff is reversed also. Okay, so this is the payoff with a put option with strike K1. This is the payoff of a put option with strike K2. So if K1 is greater or equal to K2, then the payoff of the put option K1 will be greater or equal to the payoff of a put option with strike K2. I think I made there's a typo here. So this guy should be smaller or equal. I made a quick mistake here. Okay, so here this guy should be smaller or equal, and this guy should be smaller or equal here. So because of that, if we forget about this typo, this second lie implies these inequalities about put prices. Okay, I'll just take note of this typo and fix it. So reverse the equality. Okay. Okay. So this was okay. This result tells you what's the relationship between option prices when the strike varies. So typically, option prices are monotonous with respect to the strike. So for a call price, the lower the strike, the higher the value of the option. And for a put option, it's the opposite. So you have higher put option values when strikes are higher. Okay. Now let's assume that the underlying asset does not pay dividend until the maturity of the option. Then we have the following result. Then ST, the price of the underlying asset, is always greater or equal to the price of an American option, which is always greater or equal to the price of a European option, which is always greater or equal to the maximum between 0 and ST minus K times the price of a 0 coupon at the time of the purchase, which matures at time capital T, and this guy is greater or equal to 0. Okay, so this last equality is pretty obvious because the maximum between 0 and something is greater or equal to 0. Okay, so this says that the underlying asset is worth more than an American option on that underlying asset, with an American call option on that asset, which is worth more than a European option on that asset, and the European option has a value which is greater or equal to this quantity, which we'll show subsequently. For put options, we have an analogous result. It says that the strike price, K, is greater or equal to the price of an American put with strike K, which is greater or equal to the price of a European put with strike K, which is greater or equal to this quantity. And this quantity, last quantity, is greater or equal to 0. Okay, so we can now show these results. First, inequality. So we said that the underlying asset price has a value which is greater or equal to the price of an American option on that underlying asset. And this result is simply shown by the monotonicity theorem for American options. Okay, because if we check at any possible time tau, which would be a time at which you would exercise the option, the payoff from the stock is S tau, which is greater or equal to 0. The price of a stock is never a negative, and which is greater or equal to S tau minus K. In fact, this is strictly greater than S tau minus K. So because of that, S tau is greater or equal to this and this. S tau is greater or equal to the payoff of the American option at all times. So the price of the former asset must be greater or equal to the price of the second asset. Okay, so we're going to stop here and continue the proof of this result in the last final video for this chapter. Thank you. Have a nice day.